Hi, I'm your host Danny Dividends and this is Clueless About Crypto. Welcome Dividend Trackers to our 17-part series on dividends, which is income just waiting to happen. Our guest is Wayne Smith and he will tell you more about dividends. Let's go.
Hi, my name is Wayne Smith, and I'm here to talk to you about dividends. This is going to be a little like a rant of mine, okay? It'll be just what I've seen other dividend groups talk about and how they'll scoff at you if you do some research on your own and you find dividends that are over 4%. They'll tell you the first thing that comes out of their mouth is, don't chase yield. Don't chase yield. If it's over 4%, it can't be that good. And I'm here to tell you, most of the stock, and if you know me, most of the stock that I invest in yields well over 8%. My portfolio yields 16.93% return on my investment. So don't chase yield. I've held some of those stocks since October of last year, so for 1 year. So I've seen 1 year's worth of returns on all of my investments. And the yield has been 16.93. So what does it mean? Don't chase yield. What are they really saying? Most of the times it's because they don't know the company structure, how they finance their debt, where they get their money from. They know simple little things like the earnings per share, which is not something you're going to look at when you're looking at high yield dividend companies. Earnings per share is not material to that. The number one thing you should look at is free cash flow. If the company has free cash, that flow can flow to you in a dividend. Sometimes it's called adjusted funds from operations, that's AFFO, or FFO, funds from operations, or distributed cash flow. Those are different terms for saying they have made enough money and they've allocated the money to their research and development or their continuing business operations, and now they have extra money that they can distribute. Well, why would they distribute this money to me? Again, it's not because you're a nice guy or gal, so to speak. It is because they get specialized tax treatment. And I've gone through a lot of documents where people say, don't chase yield, don't chase yield. And I've confronted them with it, and most of them do not understand why dividends are even placed out there in the beginning. They get fooled by the marketing behind it. They get fooled that, oh, it's because I'm a great person. No. This is business. These are business decisions that these companies are making, and they're making business decisions so they can pay less on their taxes. It's not because you're a great shareholder. They don't know you. Unless you hold 1 million shares, they don't know you. So don't chase yield follows into that same marketing where only companies that pay 4% or less are good companies, and that is entirely not true. My wife works for AstraZeneca, and AstraZeneca, like a lot of companies, you already know the company. You've heard of them. They had a COVID vaccine that they're trying to approve in the US, and that has been shipped around the world. Most people have taken some of their drugs, and yet AstraZeneca, like many companies, and I don't even know if I'm allowed to say this, but they borrow money to pay the dividend out. Why would a company go in debt to pay a dividend? Again, it's for specialized tax treatment. It's not because they love their shareholders. They're getting a return that is greater than the debt they're producing. And so we should keep those things in mind. So don't chase yield. A good example in one of these particular articles I'm looking at was Energy Transfer. Energy Transfer is a gargantuan company. Their balance sheets are impeccable. They have excellent leadership. They've been around. They supply power to most of the U.S., especially the lower Atlantic states around the southeast, southwest portion of the country. Energy Transfer is a humongous company. And yet this person's argument in this particular Banyan Hill article isn't very clear about why he is saying don't chase yield, other than it's over 4%. At this particular point of this article's writing, I believe Energy Transfer was tracking around 9%, I believe. And the argument, when they look at yield, most times what they say to you is, well, you know, the market makes the yield. The company determines the dividend. The executive board determines the dividend, but the market determines the yield. What they're saying to you is, if the stock appreciates in value so much, the yield will get lower because the stock price has risen and the calculation, the ratio, has changed. It's just simple math. But even that, for higher yield dividend companies, they have a tendency to trade in a narrow bandwidth. And so you kind of know what your portfolio is going to look like month in and month out. When there are crashes, those are phenomenal times to buy in very, very low and get more of the stock that's going to pay you a dividend. I was a little long-winded on this one. Don't chase yield is one of my pet peeves. I do get on a soapbox about it, but I just wanted to kind of put it out there so that you can tell for yourself what you want to do, where you want to research. I know what I do, and it fits me. I trade according to and I invest according to my personality. So I want to thank you for your time. Had a great time talking to you about this one particular subject. Let's put it to bed. And again, I like my dividends like I like my, what's a good drink? Mai Tai. No, I said that one already. I have to think of a new one. Rum Runner. Shaken, not stirred.